What is a sustainable growth rate? It is the maximum rate at a company can grow its business without having to take on additional financing. This means that the company has enough internal funds to support its growth, which is typically measured by the amount of retained earnings. The retained earnings are calculated as the net income of the company minus dividends, which are distributed to shareholders. The sustainable growth rate helps investors understand the long-term viability of a company's growth strategy. A company that is able to grow sustainably is one that is able to generate enough profits to reinvest in itself and continue growing without having to rely on external sources of financing, such as debt or equity. Next up, we're going to look at the formula to calculate the sustainable growth rate. The SGR formula is SGR equals retained earnings multiplied by the return on equity divided by 1 minus the retention ratio. The three variables in this formula represent the key pillars of sustainable growth: profitability, which is measured by the return on equity; stability, which is measured by the retention ratio; and efficiency, which is also measured by the return on equity. The return on equity, or ROE, is a measure of how much profit a company generates for every dollar of equity that it has outstanding. To calculate the ROE, you would divide the net income by the shareholder equity. Next, we have the retention ratio, which is the percentage of a company's net income that it reinvests back into the business instead of paying out to shareholders as dividends. It is calculated as the retained earnings divided by the net income. Finally, we have efficiency, which is again measured by the return on equity. The higher the return on equity, the more efficiently a company is able to use its assets to generate profits. Let's say that a company has a net income of $1 million, shareholder equity of $10 million, and a dividend payout ratio of 30%. First, we would calculate the retention ratio by dividing the retained earnings, which is the net income minus the dividends, by the net income. In this case, the retention ratio would be 70%. Next, we would calculate the return on equity by dividing the net income by the shareholder equity. In this case, the return on equity would be 10%. Finally, we would plug these values into the SGR formula to get the sustainable growth rate. SGR equals 70% multiplied by 10% divided by 1 minus 30%. This gives us a sustainable growth rate of 4.83%. So, if you're comparing two companies in the same industry, you might choose the company with the higher sustainable growth rate because it has a better combination of profitability, stability, and efficiency.